Open a ZERODHA account. Chapter 11. Hedging with Futures. 11.1 Hedging. What is it? One of the most important and practical applications of futures is hedging. In the event of any adverse market movements, hedging is a simple workaround to protect your trading positions from making a loss. Let me to attempt giving you an analogy to help you understand what hedging really is. Imagine you have a small bit of vacant barren land just outside your house. Instead of seeing it lie vacant and barren, you decide to lawn the entire plot and plant few nice flowering plants. You nurture the little garden, water it regularly, and watch it grow. Eventually your efforts are paid off and the lawn grows lush green and the flowers finally start to blossom. As the plants grow and flowers start to bloom, it starts to attract attention of the wrong kind. Soon you realize your little garden has become a hot destination for a few stray cows. You notice these stray cows merrily gazing away the grass and spoiling the nice flowers. You are really annoyed with this and decide to protect your little garden? A simple workaround is what you have in mind. You erect a fence, maybe a wooden hedge, around the garden to prevent the cows from entering your garden. This little workaround ensures your garden stays protected and also lets your garden flourish. Let us now correlate this analogy to the markets. Imagine you nurture a portfolio by picking each stock after careful analysis. Slowly you invest a sizable corpus in your portfolio. This is equivalent to the garden you grow. At some point after your money is invested in the markets, you realize that the markets may soon enter a turbulent phase which would result in portfolio losses. This is equivalent to the stray cow grazing your lawn and spoiling your flower plants. To prevent your market positions from losing money, you construct a portfolio hedge by employing futures. This is equivalent to erecting a fence wooden hedge around your garden. I hope the above analogy gave you got a fair sense of what hedging is all about. Like I had mentioned earlier, hedging is a technique to ensure your position in the market is not affected by any adverse movements. Please don't be under the impression that hedging is done only to protect a portfolio of stocks. In fact, you can employ a hedge to protect individual stock positions, albeit with some restrictions. 11.2 Hedge, but why? A common question that gets asked frequently when one discusses about hedging is why really hedge a position. Imagine this: a trader or an investor has a stock which he has purchased at 100 rupees. Now he feels the market is likely to decline and so would his stock. Given this, he can choose to do one of the following. Take no action and let his stock decline with the hope it will eventually bounce back. Sell the stock and hope to buy it back later at a lower price. Hedge the position. Firstly, let us understand what really happens when the trader decides not to hedge. Imagine the stock you invested declines from 100 rupees to, let us say, 75 rupees. We will also assume eventually as time passes by the stock will bounce back to 100 rupees. So the point here is when the stock eventually moves back to its original price. Why should one really hedge? Well, you would agree the drop from 100 rupees per to 75 rupees per is a 25% drop. However, when the stock has to move back from 75 rupees per to 100 rupees per, it is no longer a scale back of 25%. Instead, it works out to that the stock has to move by 33.33% to reach the original investment value. This means when the stock drops, it takes less effort to do so, but it requires extra efforts to scale back to the original value. Also, from my experience, I can tell you stocks do not really go up that easily unless it is a raging bull market. Hence, for this reason, whenever one anticipates a reasonably massive adverse movement in the market, it is always prudent to hedge the positions. But what about the second option? Well, the second option, where the investor sells the position and buys back the same at a later stage, requires one to time the market, which is not something easy to do. Besides, when the trader transacts frequently, he will also not get the benefit of long-term capital tax. Needless to say, frequent transaction also incurs additional transactional fees. For all these reasons, hedging makes sense, as he virtually insulates the position in the market and is therefore becomes indifferent to what really happens in the market. It is like taking vaccine shot against a virus. Hence, when the trader hedges, he can be rest assured the adverse movement in the market will not affect his position. 11.3 Risk. Before we proceed to understand how we could hedge our positions in the market, I guess it is important to understand what is that we are trying to hedge. Quite obviously, as you can imagine, we are hedging the risk. But what kind of risk? When you buy the stock of a company, you are essentially exposed to risk. In fact, there are two types of risk: systematic risk and unsystematic risk. When you buy a stock or a stock future, you are automatically exposed to both these risks. The stock can decline, resulting in losses for you for many reasons. Reasons such as declining revenue, declining profit margins, higher financing cost, high leverage, management misconduct. All these reasons represent a form of risk. In fact, there could be many other similar reasons, and this list can go on. However, if you notice, there is one thing common to all these risks: they are all company-specific risk. For example, imagine you have an investable capital of 100,000 rupees per. You decide to invest this money in HCL Technologies Limited. Few months later, HCL makes a statement that their revenues have declined. Quite obviously, HCL stock price will decline, which means you will lose money on your investment. However, this news will not impact HCL's competitors, Tech Mahindra or Mindtree, stock price. Likewise, if the management is guilty of any misconduct, then Tech Mahindra's stock price will go down and not its competitors. Clearly, these risks, which are specific to the company, affect only the company in question and not others. Such risks are often called the unsystematic risk. Unsystematic risk can be diversified, meaning instead of investing all the money in one company, you can choose to diversify and invest in 2 to 3 different companies, preferably from different sectors. When you do so, unsystematic risk is drastically reduced. Going back to the above example, imagine instead of buying HCL for the entire capital, you decide to buy HCL for 50,000 rupees per and maybe Karnataka Bank Limited for the other 50,000 rupees per. Under such a circumstance, even if HCL stock price declines owing to the unsystematic risk, the damage is only on half of the investment, as the other half is invested in a different company. In fact, instead of just 2 stocks, you can have a 5-stock or 10 or maybe 20 stock portfolio. The higher the number of stocks in your portfolio, higher the diversification and therefore lesser the unsystematic risk. This leads us to a very important question: how many stocks should a good portfolio have so that the unsystematic risk is completely diversified? Research has it that up to 21 stocks in the portfolio will have the required necessary diversification effect, and anything beyond 21 stocks may not help much in diversification. The graph below should give you a fair sense of how diversification works. As you can notice from the graph above, the unsystematic risk drastically reduces when you diversify and add more stocks. However, after about 20 stocks, the unsystematic risk is not really diversifiable. This is evident as the graph starts to flatten out after 20 stocks. In fact, the risk that remains even after diversification is called the systematic risk. Systematic risk is the risk that is common to all stocks. These are usually the macroeconomic risks which tend to affect the whole market. Examples of systematic risk include degrowth in GDP, interest rate tightening, inflation, fiscal deficit, geopolitical risk. Of course, the list can go on, but I suppose you got a fair idea of what constitutes systematic risk. Systematic risk affects all stocks. So assuming you have a well-diversified 20 stocks portfolio, a degrowth in GDP will certainly affect all 20 stocks, and hence they are all likely to decline. Systematic risk is inherent in the system and it cannot really be diversified. However, systematic risk can be hedged. So when we are talking about hedging, do bear in mind that it is not the same as diversification. Remember, we diversify to minimize unsystematic risk and we hedge to minimize systematic risk. 11.4 Hedging a single stock position. We will first talk about hedging a single stock future, as it is relatively simple and straightforward to implement. We will also understand its limitation and then proceed to understand how to hedge a portfolio of stocks. Imagine you have bought 250 shares of Infosys at 2,284 rupees per share. This works out to an investment of 571,000 rupees per. Clearly you are long on Infosys in the spot market. After you initiated this position, you realize the quarterly results are expected soon. You are worried Infosys may announce a not so favorable set of numbers, as a result of which the stock price may decline considerably. To avoid making a loss in the spot market, you decide to hedge the position. In order to hedge the position in spot, we simply have to enter a counter position in the futures market. Since the position in the spot is long, we have to short in the futures market. Here are the short futures trade details. Short futures at 2,285. Lot size equals 250. Contract value equals 571,250 rupees per. Now on one hand you are long on Infosys in spot market and on the other hand we are short on Infosys in futures price, although at different prices. However, the variation in price is not of concern as directionally we are neutral. You will shortly understand what this means. After initiating this trade, let us arbitrarily imagine different price points for Infosys and see what will be the overall impact on the positions. Arbitrary price long spot P&L short futures P&L net P&L 2200 2200 2284 equals 84 2285 2200 equals plus 85 84 plus 85 equals plus 1 2290 2290 2284 equals plus 6 2285 2290 equals minus 5 plus 6 5 equals plus 1 2500 2500 2284 equals plus 216 2285 2500 equals minus 215 plus 216 215 equals plus 1. The point to note here is, irrespective of where the price is headed, whether it increases or decreases, the position will neither make money nor lose money. It is as if the overall position is frozen. In fact, the position becomes indifferent to the market, which is why we say when a position is hedged it stays neutral to the overall market condition. As I had mentioned earlier, hedging single stock positions is very straightforward with no complications. We can use the stock's futures contract to hedge the position. But to use the stock's futures position, one must have the same number of shares as that of the lot size. If they vary, the P&L will vary and position will no longer be perfectly hedged. This leads to a few important questions. What if I have a position in a stock that does not have a futures contract? For example, South Indian Bank does not have a futures contract. Does that mean I cannot hedge a spot position in South Indian Bank? The example considered, the spot position value was 570,000 rupees per. But what if I have relatively small positions, say 50,000 rupees per or 100,000 rupees per? Is it possible to hedge such positions? In fact, the answer to both these questions is not really straightforward. We will understand how and why shortly. For now, we will proceed to understand how we can hedge multiple spot positions, usually a portfolio. In order to do so, we first need to understand something called as beta of a stock. 11.5 Understanding beta. Beta, denoted by the Greek symbol beta, plays a very crucial concept in market finance as it finds its application in multiple aspects of market finance. I guess we are at a good stage to introduce beta, as it also finds its application in hedging portfolio of stocks. In plain words, beta measures the sensitivity of the stock price with respect to the changes in the market, which means it helps us answer these kinds of questions. If market moves up by 2% tomorrow, what is the likely movement in stock XYZ? How risky or volatile is stock XYZ compared to market indices Nifty, Sensex? How risky is stock XYZ compared to stock ABC? The beta of a stock can take any value greater or lower than 0. However, the beta of the market indices Sensex and Nifty is always plus 1. Now, for example, assume beta of BPCL is plus 0.7. The following things are implied. For every plus 1.0% increase in market, BPCL is expected to move up by 0.7%. If market moves up by 1.5%, BPCL is expected to move up by 1.05%. If market decreases by 1.0%, BPCL is expected to decline by 0.7%. Because BPCL's beta is less than the market beta, 0.7% versus 1.0% by 0.3%, it is believed that BPCL is 30% less risky than markets. One can even say, BPCL relatively carries less systematic risk. Assuming HPCL's beta is 0.85%, then BPCL is believed to be less volatile compared to HPCL, therefore less risky. The following table should help you get a perspective on how to interpret beta value for stock. If beta of a stock is interpretation less than 0, x minus 0.4 AV sign indicates the stock price and markets move in the opposite direction. If market moves up by 1%, then V beta stock of minus 0.4 is expected to decline by 0.4%. Equal to 0, it means the stock is independent of the market movement. The variation in the market is not likely to affect the movement in the stock. However, stocks with 0 beta is hard to find. Higher than 0, lesser than 1. X 0.6, it means the stock and the market move in the same direction. However, the stock is relatively less risky. A move of 1% in the market influences the stock to move up by 0.6%. These are generally called the low beta stocks. Higher than 1. X 1.2, it means the stock moves in the same direction as the markets. However, the stock tends to move 20% more than the market. Meaning, if the market increases by 1.0%, the stock is expected to go up by 1.2%. Likewise, if the market declines by 1%, the stock is expected to decline by 1.2%. These are generally called the high beta stocks. As of January 2015, here is the beta value for a few blue chip stocks. Stock name beta value: ACC Limited 1.22, Axis Bank Limited 1.40, BPCL 1.42, Cipla 0.59, DLF 1.86, Infosys 0.43, LT 1.43, Maruti Suzuki 0.95, Reliance 1.27, SBI Limited 1.58, 11.6. Calculating beta in MS Excel. You can easily calculate the beta value of any stock in Excel by using a function called equals slope. Here is a step-by-step method to calculate the same. I have taken the example of TCS. Download the last 6 months daily close prices of Nifty and TCS. You can get this from the NSE website. Calculate the daily return of both Nifty and TCS. Daily return equals today closing price, previous day closing price minus 1. In a blank cell, enter the slope function. Format for the slope function is equals slope known underscore y's, known underscore x's, where known underscore y's is the array of daily return of TCS, and known underscore x's is the array of daily returns of Nifty. TCS 6-month beta, the 3rd of September 2014 to the 3rd of March 2015, works out to 0.62. You can refer to this Excel sheet for the above calculation. 11.7. Hedging a stock portfolio. Let us now focus back to hedging a portfolio of stocks by employing Nifty futures. However, before we proceed with this, you may have this question: why should we use Nifty futures to hedge a portfolio? Why not something else? Do recall there are two types of risk: systematic and unsystematic risk. When we have a diversified portfolio, we are naturally minimizing the unsystematic risk. What is left after this is the systematic risk. As we know, systematic risk is the risk associated with the markets. Hence, the best way to insulate against market risk is by employing an index which represents the market. Hence, the Nifty futures come as a natural choice to hedge the systematic risk. Assume I have 800,000 rupees per invested across the following stocks. SL no stock name stock beta investment amount. 01 ACC Limited 1.22 30,000 rupees per. 02 Axis Bank Limited 1.40 125,000 rupees per. 03 BPCL 1.42 180,000 rupees per. 04 Cipla 0.59 65,000 rupees per. 05 DLF 1.86 100,000 rupees per. 06 Infosys 0.43 75,000 rupees per. 07 LT 1.43 85,000 rupees per. 08 Maruti Suzuki 0.95 140,000 rupees per. Total 800,000 rupees per. Step 1 Portfolio Beta. There are a few steps involved in hedging a stock portfolio. As the first step, we need to calculate the overall portfolio beta. Portfolio beta is the sum of the weighted beta of each stock. Weighted beta is calculated by multiplying the individual stock beta with its respective weightage in the portfolio. Weightage of each stock in the portfolio is calculated by dividing the sum invested in each stock by the total portfolio value. For example, weightage of Axis Bank is 125,800,000 equals 15.6%. Hence the weighted beta of Axis Bank on the portfolio would be 15.6% asterisk 1.4 equals 0.21. The following table calculates the weighted beta of each stock in the portfolio. SL no stock name beta investment weight in portfolio weighted beta. 01 ACC Limited 1.22 30,000 rupees per 3.8% 0.046. 02 Axis Bank Limited 1.40 125,000 rupees per 15.6% 0.219. 03 BPCL 1.42 180,000 rupees per 22.5% 0.320. 04 Cipla 0.59 65,000 rupees per 8.1% 0.048. 05 DLF 1.86 100,000 rupees per 12.5% 0.233. 06 Infosys 0.43 75,000 rupees per 9.4% 0.040. 07 LT 1.43 85,000 rupees per 10.6% 0.152. 08 Maruti Suzuki 0.95 140,000 rupees per 17.5% 0.166. Total 800,000 rupees per 100% 1.223. The sum of the weighted beta is the overall portfolio beta. For the portfolio above, the beta happens to be 1.223. This means, if Nifty goes up by 1%, the portfolio as a whole is expected to go up by 1.223%. Likewise, if Nifty goes down, the portfolio is expected to go down by 1.223%. Step 2. Calculate the hedge value. Hedge value is simply the product of the portfolio beta and the total portfolio investment. Equals 1.223 asterisk 800,000. Equals 978,400. Remember, this is a long-only portfolio, where we have purchased these stocks in the spot market. We know in order to hedge we need to take a counter position in the futures markets. The hedge value suggests, to hedge a portfolio of 800,000 rupees per, we need to short futures worth 978,400 rupees per. This should be quite intuitive as the portfolio is a high beta portfolio. Step 3. Calculate the number of lots required. At present, Nifty Futures is trading at 9,025. And with the current lot size of 25, the contract value per lot works out to equals 9,025 asterisk 25. Equals 225,625 rupees per. Hence the number of lots required to short Nifty Futures would be equals hedge value, contract value, equals 978,400 225,625 equals 4.33. The calculation above suggests that, in order to perfectly hedge a portfolio of 800,000 rupees per with a beta of 1.223, one needs to short 4.33 lots of Nifty Futures. Clearly, we cannot short 4.33 lots as we can short either 4 or 5 lots. Fractional lot sizes are not available. If we choose to short 4 lots, we would be slightly underhedged. Likewise, if we short 5 units, we would be overhedged. In fact, for this reason, we cannot always perfectly hedge a portfolio. Now, let us assume after employing the hedge, Nifty in fact goes down by 500 points or about 5.5%. With this we will calculate the effectiveness of the portfolio hedge. Just for the purpose of illustration, I will assume we can short 4.33 lots. Nifty position. Short initiated at 9,025. Decline in value 500 points. Nifty value 8,525. Number of lots 4.33. P&L equals 4.33 asterisk 25 asterisk 500 equals 54,125 rupees. The short position has gained 54,125 rupees per. We will look into what could have happened on the portfolio. Portfolio position. Portfolio value equals 800,000 rupees per. Portfolio beta equals 1.223. Decline in market equals 5.5%. Expected decline in portfolio equals 5.5% asterisk 1.233 equals 6.78%. Equals 6.78% asterisk 800,000. Equals Rs. 54,240. Hence, as you can see, one hand the Nifty short position has gained 54,125 rupees and on the other hand the long portfolio has lost 54,240 rupees per. As a net result, there is no loss or gain. Please ignore the minor difference in the net position in the market. The loss in portfolio is offset by the gain in the Nifty futures position. With this, I hope you are now in a position to understand how you could hedge a portfolio of stocks. I would encourage you to replace 4.33 lots by either 4 or 5 lots and run the same exercise. Finally, before we wrap up this chapter, let us revisit 2 unanswered questions that we posted when we discussed hedging single stock positions. I will repost the same here for your convenience. What if I have a position in a stock that does not have a futures contract? For example, South Indian Bank does not have a futures contract. Does that mean I cannot hedge a spot position in South Indian Bank? The example considered. The spot position value was 570,000 rupees per. But what if I have relatively small positions, say 50,000 rupees per or 100,000 rupees per? Is it possible to hedge such positions? Well, you can hedge stocks that do not have stock futures. For example, assume you have 500,000 rupees per worth of South Indian Bank. All you need to do is multiply the stock's beta with the investment value to identify the hedge value. Assuming the stock has a beta of 0.75. The hedge value would be 500,000 asterisk 0.75 equals 375,000. Once you arrive at this, directly divide the hedge value by the Nifty's contract value to estimate the number of lots required to short in the futures market. And hence with this you can hedge the spot positions safely. As far as the second question goes, no. You cannot hedge small positions whose value is relatively lower than the contract value of Nifty. However, you can hedge such positions by employing options. We will discuss the same when we take up options. Key takeaways from this chapter. Hedging allows you to insulate your market position against any adverse movements in the market. When you hedge your loss in the spot market, it is offset by gains in the futures market. There are 2 types of risk: systematic and unsystematic risk. Systematic risk is risk specific to macroeconomic events. Systematic risk can be hedged. Systematic risk is common to all stocks. Unsystematic risk is the risk associated with the company. This is unique to each company. Unsystematic risk cannot be hedged, but can be diversified. Research suggests beyond 21 stocks, unsystematic risk cannot be diversified any further. To hedge a single stock position in spot, we simply have to take a counter position in the futures market. But the extent of spot value and futures value have to be same. Market beta is always plus 1.0. Beta measures the sensitivity of stock. Stock with beta of less than 1 is called low beta stock. Stocks with beta higher than 1 is called a high beta stock. One can easily estimate the stock beta in MS Excel by employing the slope function. To hedge a portfolio of stocks, we need to follow the following steps. Calculate individual stock beta. Calculate individual weightage of each stock in the portfolio. Estimate the weighted beta of each stock. Sum up the weighted beta to get the portfolio beta. Multiply the portfolio beta with portfolio value to get the hedge value. Divide the hedge value by Nifty contract value to get the number of lots. Short the required number of lots in the futures market. Remember, a perfect hedge is difficult to construct. For this reason, we are forced to either underhedge or overhedge. 119 responses to hedging with futures. Open a ZERODHA account. Chapter 12. Open interest. 12.1 Open interest and its calculation. Before we conclude this module on futures trading, we must address one of the questions that is often asked: what is open interest, OI? How is it different from volumes? And how can we benefit from the volumes and open interest data? Let me attempt to answer these questions and more in this chapter. After reading this, you will be able to interpret OI data in conjunction with the volumes to make better decisions while trading. Also, I would suggest you refresh your understanding on volumes from here. Open interest, OI, is a number that tells you how many futures or options contracts are currently outstanding, open, in the market. Remember that there are always two sides to a trade, a buyer and a seller. Let us say the seller sells one contract to the buyer. The buyer is said to be long on the contract and the seller is said to be short on the same contract. The open interest in this case is said to be 1. Let me illustrate OI with an example. Assume the market consists of 5 traders who trade Nifty futures. We will name the margin Neha, Varun, John, and Vikram. Let us go through their day-to-day trading activity and observe how open interest varies. Please note, you need to exercise some patience while understanding the flow of events below. Else you can quite easily get frustrated. Let's get started. Monday, Arjun buys 6 futures contracts and Varun buys 4 futures contracts, while Neha sells all of those 10 contracts. After this transaction, there are 10 contracts in total, with 10 on the long side, 6 plus 4, and another 10 on the short side. Hence the open interest is 10. This is summarized in the table below. Tuesday, Neha wants to get rid of 8 contracts out of the 10 contracts she holds, which she does. John comes into the market and takes on the 8 shorts contracts from her. You must realize that this transaction did not create any new contracts in the market. It was a simple transfer from one person to another. Hence the OI will still stand at 10. Tuesday's transaction is summarized in the table below. Wednesday, to the existing 8 short contracts, John wants to add 7 more short positions, while at the same time both Arjun and Varun decide to increase their long position. Hence John sold 3 contracts to Arjun and 2 contracts to Varun. Note, these are 5 new contracts created. Neha decides to close out her open positions by going long on 2 contracts. She effectively transferred 2 of her short contracts to John, and hence Neha holds no more contracts. The table now looks like this. By the end of Wednesday, there are 15 long, 9 plus 6, and 15 short positions in the market. Hence OI stands at 15. Thursday, a big guy named Vikram comes to the market and sells 25 contracts. John decides to liquidate 10 contracts, and hence buys 10 contracts from Vikram, effectively transferring his 10 contracts to Vikram. Arjun adds 10 more contracts from Vikram, and finally Varun decides to buy the remaining 5 contracts from Vikram. In summary, 15 new contracts got added to the system. OI now stands at 30. Friday, Vikram decides to square off 20 of the 25 contracts he had sold previously, so he buys 10 contracts each from Arjun and Varun. This means $20 contracts in system got squared off. Hence OI reduces by 20 contracts. The new OI is 30 to 20 equals 10. The final summary is listed in the table below. So on and so forth. I hope the above discussion is giving you a fair sense of what open interest OI is all about. The OI information just indicates how many open positions are there in the market. Here is something you should have noticed by now. In the contracts held column, if you assign a plus V sign to a long position and a V sign to a short position and add up the long and short positions, it always equates to 0. In fact, this is one of the primary reasons derivatives is often termed as a zero-sum game. Have a look at the following snapshot. As of the 4th of March 2015, OI on Nifty Futures is roughly 2.78 crores. It means that there are 2.78 crore long Nifty positions and 2.78 crore short Nifty positions also. About 55,255 or 0.2% over 2.78 CRS new contracts have been added today. OI is very useful in understanding how liquid the market is. Bigger the open interest, more liquid the market is. And hence it will be easier to enter or exit trades at competitive bid-ask rates. 12.2 OI and volume interpretation. Open interest information tells us how many contracts are open and live in the market. Volume, on the other hand, tells us how many trades were executed on the given day. For every one buy and one sell, volume adds up to 1. For instance, on a given day, 400 contracts were bought and 400 were sold. Then the volume for the day is 400 and not 800. Clearly, volumes and open interest are two different, by seemingly similar set of information. The volume counter starts from 0 at the start of the day and increments as and when new trades occur. Hence the volume data always increases on an intraday basis. However, OI is not discrete like volumes. OI stacks up or reduces based on the entry and exit of traders. In fact, for the example we have just discussed, let us summarize the OI and volume information. Notice how OI and volume change on a daily basis. Today's volume has no implication on tomorrow's volume. However, it is not true for OI. From a standalone perspective, both OI and volume numbers are pretty useless. However, traders generally associate these numbers with prices to draw an inference about the market. The following table summarizes the trader's perspective with respect to changes in volume and prices. Price volume trader's perception. Increase bullish. Decrease bearish trend could probably end. Expect reversal. Decrease bearish. Increase bullish trend could probably end. Expect reversal. Unlike volumes, the change in open interest does not really convey any directional view on markets. However, it does give a sense of strength between bullish and bearish positions. The following table summarizes the trader's perspective with respect to changes in the OI and prices. Price OI trader's perception. Increase more trades on the long side. Decrease longs are covering their position, also called long unwinding. Decrease more trades on the short side. Decrease shorts are covering their position, also called short covering. Denote. If there is an abnormally high OI backed by a rapid increase or decrease in prices, then be cautious. This situation simply means that there is a lot of euphoria and leverage being built up in the market. In situations like this, even a small trigger could lead to a lot of panic in the market. And with this, I would like to conclude this module on futures trading. I hope you enjoyed reading through this module as much as I enjoyed writing it. Onwards to option theory now. Key takeaways from this chapter. Open interest OI is a number that tells you how many contracts are currently outstanding open in the market. OI increases when new contracts are added. OI decreases when contracts are squared off. OI does not change when there is transfer of contracts from one party to another. Unlike volumes, OI is continuous data. On a stand-alone basis, OI and volume information does not convey information. Hence, it makes sense to always pair it with the price to understand the impact of their respective variation. Abnormally high OI indicates high leverage. Beware of such situations.